Good evening, all. Ira Epstein with your weekend edition of your financial market wrap-up for Friday. I want to get this out for the whole weekend, and this is the 23rd of September, 2022. So today we came in the day after all the central banks raised interest rates, but we walked into another pile of you-know-what in the British pound. The Parliament there went along with new Prime Minister Truss's plan to cut taxes, and it's a whole range of things. It's income taxes, it's if you buy a home, taxes on that. There's just one after the other. They went with a windfall tax on domestic energy companies to help pay for some of that. And at the same time, it's forcing the bank to take a look at what's going on, and should they have gone even further with their interest rate hike. There's even calls they should have an emergency meeting. How did the market react to this all? You fell 400 points, 4 cents on the pound. This is monstrous. These are levels, I think they're 37 years ago that we saw levels like this. What did it do to the euro? Killed it, down nearly 2 cents. This is a bounce at 97.32, slightly off the low, not very much. So down 1.6. So my buddy that's in Sicily right now, I'm sure he's having the best prices he can imagine. The dollar is just reigning supreme. Which brings us to here. Now, I wrote about what the Brits did this morning in my update. My clients, to get my full research, have a full review of what that is, parts that people like, don't like, but I went into it. And you can read about it all through the weekend, I'm sure, in your local press. But if you get my research, you already have it. And I think you got a detailed analysis. I want to go on record here in these stock indices. I think on a weekly chart, you reach the point where the market doesn't have to drop a lot more before a bounce happens. I am not calling for this is the bottom. No. A bounce. We have fallen hard. It is time to get a bounce. And I do think that if it works out the way I think on the weekly chart, it'll be a selling bounce, but it may take a while to come alive. If you take a look for the week, we are down 6.26%. The market rolled over, got under, as I tell you, the line in the sand. And there's so much importance to this. You know, I know sometimes the simplest things are the best things. The market is underneath the 18-week average. It means you have a downside bias. When it's over it, you have an upside bias. Simple. Keeps you clean in the market. So as I said, we were down 6.2% this week. We were down last week 4.28. You were up 9, so that's -1, but then you can go back and you were down 8. You see what I'm getting at? From the peak, you have fallen. I'm not going to do this whole exercise here, but from the peak, you are now back into bear territory in many of the different indices. You're back in, as charts would say, that 20% from the 52-week high, and that puts you back into the bear market. When I look at a weekly area chart of just closes, that was, if we come back here, that's your monthly chart. I hope I said monthly, but that's monthly. Weekly, you were down 4.9%. And when you take a look at this chart, it's been ugly, all right? And here we are attacking again these June lows. Now remember, different contract months will be higher than lower. So when June was here, we were trading the SEP contract. But if you go to the cash market, you will see those lows were definitely attacked. So what do we have? We have a pattern where we have lower highs, lower lows. So the trend is down. You had an outside week this week, not the week we're in now, the week before. That high not taken out. You made the lower low. Bang, the market lets go on you. The market had a bearish crossover here where the 18-week got under the 100, and it owed a challenge of the most recent low. You heard me say that when it occurred. Go back. These videos are all there. And that is what I thought would happen. As that happened, I remember going up, and trader after trader was telling me, we're going up. Ira, you're wrong. The lows are in. This market's going to rally. And I said, I don't know. We just got this, and as soon as you close back under that 18-week, it's like a trigger. It should be able to kick off this thing without getting over that high to those lows. That's the way that I teach it. And it's what's turning out. Now, I'm keeping a very close eye here on the 200-week at 35.84. Yes, you can get there, but I'm looking at where the Bollinger Band is with it. 36.49, let's call it. Today's low was 36.60. So between there and the 200-day, and it doesn't have to hit them. You're in the zone already. I can make an argument for the market to get a spin around over the next 1 to 3 weeks, whatever it is, trying to get a rally in place. Remember, it's a weekly chart, and I think the pros, whenever it rallies, are going to try to sell short into the 18-week average. Now, if it goes too late to happen, then I get concerned, because unlike so many traders that came out yesterday saying, no, there's not going to be a Santa Claus rally, that year-end rally pattern is not going to happen, I happen to think there's still a good chance of it. And the reason is, I am not looking for a crash from this level down to 2,500 or anything like that. Too many people have jobs, and those jobs support the economy. I understand what's going on here. I have been writing in my full research that the PE ratio, you've got like, if you look at the top tier companies and what their PEs are, they're too high. Apple fits in that. Microsoft fits in that. I think they have to come down. And as they come down, that's one thing, but I don't think that you take the whole market down, because you've taken a lot of this down already. The market is working, and that is what I look at. So I'm looking for this market to get that bounce somewhere. And when it comes on, if it's early, because I still think we'll be weak in the month of October, I think that that's your next chance. In the momentum, down. So trend down, lower highs, lower lows, bias down, support around the 36.60 to 35.84 level, let's call it. Resistance back up 39.85 roughly. In the Dow, you went right to the 200-day average and the Bollinger Band. I'm at that zone. So if you were sitting next to me, you'd get the elbow just like that. Hey, cover your short positions. You go, why? And I'd say, just like it was up here, when it got to the 100 in the upper Bollinger Band, you got the same thing here. The public's overly bullish there. They're getting overly bearish down here. And you'll say, well, does that mean we can go long? And I'll say no. It means to be out of shorts, get your ammunition ready to try sell shorts on the market on a good hard rally, ideally towards that 18-week average. The Russell's not in that game. You got under both the 200 and the 18, so your resistance is going to be up there. I'd like to get it back into that game to play it, but I'd like to get closer, and that's all I'm saying, to the 1644 level. You got to 1662. That's all. Same concept at work there. 30-year bonds, do you go short under Bollinger Bands? Absolutely not. So what I happen to think is, if you saw Jeremy Siegel from Wharton today on CNBC, he had a meltdown. You might want to go on CNBC and take a look at the interview. And his argument is the Fed doesn't have to do what they're doing, and generally they're late to the party anyways. They're raising rates now when inflation on its own is going to take a hit in different parts. And you're seeing that in certain things as the dollar is gaining strength. Our goods, we have become a net exporter in America of inflation. Anything priced in dollars, we don't have to make it here. Anything priced in dollars in the world is, over the past 72 hours, substantially more expensive. It's that simple. Put it on your credit card, you've just bought it cheaper in Europe, wherever you're going. If you have a good credit card company, they're going to convert it to the rate or whatever their way of doing it is. But it got cheaper for you. It's getting more expensive for the Europeans. They want to buy our WTI oil. Example, the euro fell today, penny and a half. Well, they got to pay that in the dollar. It just got more expensive. It doesn't matter if energy was down today, $4 a barrel. It's still a penny and a half more into the $4 break. You see what I'm getting at? I hope I'm making sense to you. So when you look at this, you're down enough where I think you'll climb back into the Bollinger Band. I also don't think what the Fed's doing is going to materially impact 30-year bonds. It'll have a bit more impact on the 10-year, but it too is under the band. No. If you go back on charts and you sell under Bollinger Bands, you realize you have a better chance down the road of getting a better price where you don't know how deep it's going to break before it snaps back into the band. So you could be selling into the hole. That doesn't mean the trend isn't down. I think there's a better way to come in it. In the dollar index, it's the same thing. The pros come out against Bollinger Bands. As you embed it, I've been telling you, I think the pros are buying looking for the market to keep going until the pattern ends by the red line closing under 79. When that happens, I will say the market has reached its peak. Hasn't done it at this point. I will continue to say on the breaks, you buy the dollar, looking for the higher prices. It's taught in my enhanced Bollinger Band course, our website, under research. In the eurocurrency, same thing. You have an embedded reading. The market's giving you rallies, and down you go. Now, I admit, I wasn't playing those rallies. I have a rule of thumb that I don't have my clients go through quote-unquote major reports. To me, the major report was the CPI report because it would set what the Fed was going to do. The Fed raising 75 basis points wasn't really the key part of it. I knew it was going to be the dot plot, and I knew it would be what the Fed chair came out, and he was just a super hawk. He's going to stay a super hawk. He's got to beat inflation down. This is his legacy. It's his last run at being our Fed chair, and he's not going to leave with the egg on his face. He keeps mentioning Volcker getting and going too soon by taking his foot off the brake, and this man is not going to take his foot off that brake too soon. He'll be late, so he'll overdo it, and that's what Jeremy Siegel was in part complaining about today. He understands just what's going to happen there. But in any case, how the market's working is you get down. That's where I think short covering comes in. You're embedded. On hard rallies, I think the pros will sell the market. But on rallies, not into this break. Canadian dollar's in a meltdown. It just completely came up. It's undone. Under the band, I teach you never go short under a Bollinger Band. I won't change. Japanese yen, this market, in my opinion, is still going lower, maybe a lot lower. Why? They are determined to get inflation. They don't want to change their monetary policy. So it's they and Turkey against the world. They're going to just keep either not raising rates or lowering rates, and that's what you have going on here. Other banks, I see it happening. Oh, if Australia, we'll raise our rate, but this is going to be close to the end of it. Nonsense. It'll be close to the end of it when the dollar stops appreciating. Every bank looks at America. Don't believe what they say different. Higher high, lower low, getting a bounce. I think the market on further bounce is a short sale. Bitcoin still bearish. I'm surprised it hasn't gotten down to 16,114. If the market can clear right up through last week's high and close over it, let's see if we can get there. That number was 22,875. That might be a sign that this is really a bottom shaping up in the market. You're not there yet. And what will the pros do? Well, if you embed, they're going to keep selling the market. Then we get to the differential between WTI and crude, and you can see it's still climbing back up here towards 741, but all the energies are in a bear phase. Why? Because the dollar got strong, number one. Number two, because the central banks are all raising rates to hurt demand. And to a degree, there's flexibility in the demand of oil, natural gas to a degree. And that's what you're going through to a degree. Now, when it gets cold outside and people need heat, that degree goes away. So you keep watching to see when that's going to show up. You're not there. On the Brent, if the market continues down with an embedded reading, look for major support to come in 80.94 to 83.11. Right now, the bears have control of the market. WTI crude. You're at the beginning of the support zone right now. It's 77.45. The 100-day average got to 78.04. You're in the zone. Between there and the Bollinger Band is where I'm looking for the support. I don't believe you'll make it down to $63 a barrel, the 200-day average. It could happen, but I think that it would be a gift long-term to own $60 oil. I think natural gas, like $6, if it ever got there, that would be a gift. Gasoline keeps challenging here this 200-week average. It is embedded. It is still bearish. If this gives ground, then you come back into the Bollinger Band back here at 205 to 195. That could happen. Gasoline isn't heating oil. You'll need the heating oil a lot more than the gasoline come the cold weather. So you put it all together, you're trying to come up with your game plan, and that's where I want to fit in for you. And how do I do it? Early in the morning, and we are talking, I begin this, let me see if I can get this to come up the right way for us. That should do it. Right. I begin trading, I shouldn't say trading, I begin recording my futures and ETF videos at approximately 5:30 in the morning. I'm up early, folks. I've read, I've seen what's going on in Asia, Europe, the market reports coming out, and I prep you with them. Then the next thing we do is we start talking about what's coming out in America that day, what the possible impact from them might be, and then we go right to the charts. During the week, typically, and I call the week, from Monday morning through Friday, I'm doing daily charts with a little bit of mixture in for the weekly. On Friday or Saturday, and I've already done these for this week, I do just weekly charts, and my traders get the bigger view off of longer term trades. Now, the risk is always bigger longer term, but sometimes so are the gains. So everything gets sort of matched up with where you'd want to be and what you're looking at. I cover all these different categories and all the futures markets in it. Typically 40 to 45 charts are covered. I realize time is your enemy. So at the bottom, there's a scroll bar on the website. You just grab it, and it'll take you from section to section that's in here in the ETF and or the futures. So you can go right with what you want. Oh, that's what he's looking at, and away you go. An added bonus, you get my email address. So write me. You got a question? Often, I will make a short 1-minute video for you of the charts that I'm seeing, answering your question, what's it doing, what I'm seeing in it, send it right back to you. Could it be easier than that? How do you get this? You go to our website, under the word research, you can click right over me. There'll be an icon that'll pop up here if you move your cursor there. Click on it, read about it. That's where you sign up if you decide to do it. I hope you do. I'm Ira Epstein. Have yourselves a great weekend. I'll see you all come again Monday. Take care.